Then, still with equipment, they say provide for depreciation on equipment at 10% per annum on cost price. The method of depreciation for equipment is cost price. At what rate? At 10% per annum. Fine. Now, when we make that calculation, you need to distinguish between depreciation on equipment that was used for the whole year, which is our old equipment, and depreciation of equipment on equipment that was used for only part of the year. You cannot use this amount because it includes both new and old. You have to calculate depreciation on the old equipment and also calculate depreciation on the new equipment because they were used for various periods. Remember, depreciation is the reduction in the value of an asset through wear and tear, through usage. Therefore, the period for which you use an asset becomes very important. Right. Now we are calculating depreciation on equipment. Like I said, we are going to distinguish on old equipment that we used for the whole year. Right. The value of our depreciation of our equipment at the beginning of the year was 561,000. 561,000. Okay? Then we simply multiply by rate of depreciation 10 over 100 because they said it's on cost price. And then we used it for the whole year. We multiply by 12 over 12. And then your simple arithmetic will tell you that it will be 56,100. But anyway, you have 561,000 multiplied by 10%. This gives us 56,100. Right? Let me put it here. 56,100. That is on the old equipment. On the new equipment, we bought the new equipment. The new equipment was used only for part of the year. But we know that we bought the new equipment. We are told that we bought the new equipment for 55,000. Then we have your 55,000 multiply by 10 over 100. Now, we did not use it for the whole year. Therefore, we cannot multiply by 12 over 12. Okay? Therefore, we must find out the period for which we have used the equipment. And that is contained in our additional information. They said new equipment was purchased or was bought halfway through the year. Now, I'm sure that even those of us who do not speak English as a mother tongue, we would know that halfway is 6 months. A year consists of 12 months, and halfway through the year would be 6 months, which means now that the equipment was bought on 31 December. 31. Here we are. Was bought on 31 December 2011. So that we have 6 months this side we have 6 months that side. So I'm sure you can see where I got it the 6 months from. They said it was bought halfway through the year, and therefore it was used only from 31 December up to 30 June. There we are. Therefore, we need to multiply by 6/12. Then we'll have 55,000. You'll have 55,000. Multiply by 10%, multiply by 6 divided by 12. You will have 2,750. 2,750. Right. When you add the two amounts, 2,750 plus 56,100, they give you 58,850. That will give you 58,850. This is the amount of the depreciation which must be subtracted. I'm doing this so that if I get any of the calculated amounts wrong, at least I will earn part marks. Are we together? So you must always try to do that. For an example, if I had this one wrong, correct, and I got this one wrong, I will still get that mark as a part mark. So make sure that you show all your workings. If you don't show them here, you can show them here. Then you have this is our. Now, what are we left with? We are left with, the instruction goes on. Now we come to vehicles. They say a vehicle was sold for cash at carrying value on 31 March. There they are again. It was sold at carrying value. Now, when you sell something at carrying value, it means you did not make a profit or a loss on the sale of that particular item. You did not make a profit or a loss on the sale of that item. I will demonstrate by means of a T account what I mean by that. You normally prepare your asset disposal to check whether an asset was sold at a profit or a loss, right? Fine. Now, here they tell us that this asset, the cost price was 165,000. The cost price is always on the debit side of the account. Therefore, you will have vehicles, 165,000 rand. The question did not request you to prepare the asset disposal. I'm simply throwing it in because some of you struggle with it as well. Now, on the credit side of the account, you would have your accumulated depreciation. This accumulated depreciation is on date of sale. That accumulated depreciation is on date of sale, which is actually what we want to calculate. Right? Fine. But what are we giving? We are not giving accumulated depreciation on date of sale. We are giving what? Accumulated depreciation at the beginning of the financial year. But they said to us that this asset, 1 July 2011, our financial year started on 1 July 2011, ends on 30 June 2012. They said we sold this where? 31 March 2012. Which means we have used this from July up to 31 March. And then if you count the number of months there, it will give you 9 months. because it's July, August, September, October, November, December, January, February, and March. 9 months. This asset was used for 9 months. Now we want the accumulated depreciation on the date of sale. Fine.